Hi, welcome back to the class. In this class, we'll be talking about swing trading versus day trading. Now, there's this tussle of power between the swing trader and the day trader. People want to compare side to side who is a better trader, whether you're better off swing trading or you're better off day trading. In the previous class, I've tried to explain the 5 styles of trading, starting from the high frequency trading to the scalping. So for the purpose of this course, we'll be narrowing down to swing trading and day trading. So in this part of the course, we will look at swing trading and day trading, find out the similarities between them, find the differences between them, then look at the meeting point between a swing trader and a day trader. This course, this model promises to be very interesting, so I would urge you to pay attention and take down as much notes as possible and feedback with your questions. So let's dive into the course. So the objectives of this course is, at the end of the module or the course, you should know the differences and the similarities between the day trader and the swing trader. Now we'll narrow down to simplifying swing trading. That's swing trading simplified. After that, we'll talk in details about day trading with the mindset of a swing trader. My approach to trading actually is not to define myself or restrict myself to just day trading or swing trading. I want to marry them together. I want to be able to swing trade when I find opportunities for a swing trade, and also day trade when I find opportunities for a day trade. Now you can decide what type of trades you want to be taking, whether a day trade or a swing trade. It's all up to you. By the time we are done with this class, you will find out if you are better off day trading or you're better off swing trading. Believe me, you can make profit from any style of trading. The only thing you need to understand is the laws or the rules governing each style of trading. Once you apply those rules, you'll be able to trade successfully and consistently. So let's go to the next slide. The differences and similarities between day trader and the swing trader. Swing trading and day trading are the same in terms of technical and fundamental and trade execution. So now, if you ask some traders, they will tell you that a day trader should execute his trade around 4 hours. That's using the 4-hour time frame, or the daily time frame. That's the swing trader rather, or the daily time frame or the weekly. While the day trader will go down to 15 minutes, 30 minutes time frame to execute their trade. In my experience, I know that this is not exactly the truth. Now look at what the truth is. You can execute your trade in as low as 15 minutes as a swing trader. Now, what determines what type of trade you're taking, whether it's a swing trade or a day trade, is the length of time you leave your positions open, not the time frame in which you take your trade. I'll repeat that. It's not the time frame that you take your trade that determine what type of trade or what type of trader you are. Now, however, the differences is the holding time for position. So the difference is the holding time for position for any trade you are taking. So if you take a trade now, let's say you take a trade in 4 hours, and that trade closes within one trading day, that is within a trading day, doesn't spill over to the next trading day, you have just day traded, irrespective of the fact that you took the trade in a 4-hour time, on a 4-hour time frame or a daily time frame. So you can also scale down after you've done your analysis. When we talk about multi-time frame analysis, you understand this. You can even scale down to 15 minutes and take a trade that will last you for 1 week, 2 weeks. In that case, you are just swing trading, but you executed your trade on a lower time frame, like 15 minutes. So it's not the time frame, rather it is the holding time that determines what type of trade you are going to be taking. Now, most traders are afraid to swing trade because they don't have the emotional strength to hold trades for a long time. Now, this is where the difference comes into play. Someone that has built emotions or has built emotional strength can leave his trade to play out for days, for weeks before closing it. But a trader that is anxious, that wants to know the result of a trade quickly, would want to close the trade between a trading day, few hours to just a trading day. So such traders begin to look at just day trading or swing trading, depending on your emotional strength, and also because of the size of their trading account. Now, a lot of day traders don't have that huge capital to execute their trades on a higher time frame, like the daily and the 4 hours and the weekly. Now, what you should understand is that if you execute your trades on a high time frame, the stop loss, the number of pips for the stop loss is usually very high. But when you scale down to a lower time frame, the stop loss is low, so helping you to be able to execute trades even with a very small amount. So a lot of traders go down to lower time frames and prefer entering trades on a lower time frame because of the size of the account. Now, what now determines if they are going to be day trading is whether they close off that trade within a trading day. They don't want to incur swap fee and all that, overnight charging fees and all that. So the danger with just looking at the lower time frame as a day trader is that you lose perspective of the big picture. Now, what do I mean by the big picture? If you go on the higher time frame, you are able to see exactly what the pair is doing. So the approach we'll be taking in this course is being able to analyze trades on a higher time frame so that we know the actual direction price is taking, then scaling down to much lower time frame. We can even scale down to 5 minutes to make entries that will take us through a very long time. Even if you want to leave that trade to run for months, it's all your call. So in this, as we go on, I will explain this further. Let's go to the next slide. Multi-time frame analysis. The almighty multi-time frame analysis. Guys, if you understand this, you will be able to know the direction of play. Now, another advantage of analyzing multi-time frames or analyzing from the top to the bottom is that it helps you to stay on the side of the fundamentals. Now, what do I mean by the fundamentals? The news propels the market. It's the news or the fundamentals that moves the market, while you come down to the charts, the technicals, to determine the right price to buy or sell. Now, if you analyze your trades as a technical trader on the higher time frame, most of the times you will stay on the side of the fundamentals, meaning that you will be doing a little bit of fundamental analysis. So with the approach of the multi-time frame analysis, you analyze from a higher time frame and scale down to execute the trade on a lower time frame in the higher time frame, which will be suitable for both the day trader and the swing trader. So you see now, doing multi-time frame analysis is helpful both for the swing trader and the day trader. So don't be a day trader that just looks at the 15 minutes or 1 hour time frame without taking note of what is happening on the higher time frame. If you do that, most of the times you'll be stopped out and trades will go in your direction, or you may be trading against the major flow, which is major trend, which is not good for trading. Swing trading simplified. So let's go further. Swing trader. The swing trader attempts to make profit from the distance between the major turning points on the price chart, known as the swing high and the swing low. I know I explained this before. Now, the holding period of swing trading ranges from a day to a few weeks. We've said this in the previous class, so I go on. So now, looking at this chart, I want to explain this. A swing trader wants to make profit. You see now, there are several swings on this chart. The red part are the major swings. Now, why do I call them the major swings? It is from this swing that you have a prolonged trend. A prolonged trend from this point to this point. Look at this, from this point to this point, from here to here. Now, apart from these red points that I've marked out as swing point, there are other minor swings. This is a minor swing. Now, this is also a minor swing. Now, imagine that you are on a 15 minutes time frame. You would have been seeing this as a major swing. Now you try to sell, not knowing that this is just a minor retracement for a bigger impulse move. Now, when you try to sell, price just comes back against you. Let's say you enter here and you are targeting all the way down. By the time price gets here, it comes back against you and stops you out. So this is why it is important for you to do the multi-time frame analysis. So the swing trader looks at the overall view. He tries to make entries close to the major swings. How do you identify these major swings? You go to the higher time frame. Time frames like the daily and the weekly and the monthly give you clear vision on where the major swings are. Another thing you should note about the major swing is that the trade or the trend starts from a major swing. High level trends or prolonged trends start from the major swing. So identifying the major swing, whether as a day trader or as a swing trader, helps you enter the trade early and allows you to maximize profit. So let's go on. The major and the minor swing. Well, I think I've already done justice to this, but let's just read what we have. It says the swing high and the swing low are collectively called swing points, while the distance between the swing high and the swing low is called the swing body. Let me go back to our chart. Now this is the swing points, swing low, swing high. Now the distance between them is called the swing body. This distance from here to here is the change in price for this pair. Let's say this pair is Euro USD. When the price moves from here to here, this is measured in pips. In pips. Is measured in pips. One standard lot of pip is usually equal to 1 pip for one standard lot is usually approximately $10. So if you have 0.1 standard lot, it means that if you make a profit of 1 pip, you'll be making $10. If you have 0.01, if the trade goes in your favor by 1 pip, you'll be making 0.1. I believe this is clear. You can replay this to understand that better. So let's go forward. The difference between the two swing points is measured in pips. As the price changes, the change is measured in pips. The major swings are the turning points that give rise to very prolonged trend. I have said this. This is more visible when you are on the higher time frame, like the daily, the weekly, and the monthly. Identifying the major swing is very important for both the day trader and the swing trader because it helps you know the phase of the movement of a price at a particular time. Now, if you're able to know or identify the major swing of a move, it will help you to know on what phase of that movement, whether you are on the retracement phase or the impulse phase. Now, it helps you to make better trading decision. It helps you to understand if price is retracing at the moment or is headed back in the direction of the general flow. This in turn will help you make better trading decisions. So your approach to trading should be, first of all, go to the higher time frame. Start from the monthly, the weekly, identify these major swings. It will help you trade better. The minor swings. The minor swings are the swings that form as a result of retracement or consolidation of price. Now, you should know that price does not just go in a linear direction. It goes up, it comes down. So let's say it's an upward trend. The upward move is the impulse, the downward move is the consolidation. So the swings that form as a result of consolidation are minor swings. They are very much visible on the lower time frames like 15 minutes, 1 hour, and 4 hours. I refer to them as take profit zones or break even zones. Now, when we enter execution, I will show you why I refer to them as take profit, break even zones, or position scale up zones. So let's not preempt our course. Let's go into the next, identifying the swings. Now, for thus to make profitable trade decisions in forex, a trader must learn how to identify points on the price chart where price has a high probability of turning. What this means is, as traders, our major job is to identify possible turning points. I've said it before. Our major job is to identify possible turning points. Now, once you identify these turning points, you can sit and watch for price action as price navigates towards the possible turning points. Now, technical analysis is all about determining possible price turning points on the chart by studying historical price action. The first method to identify turning points on the chart is using our eyes. Look for the most obvious swings on the daily, weekly, and the monthly time frame. Different technical strategies and tools like supports and resistance, Fibonacci retracement, demand and supply zone strategies are also used to identify these swings. So all these strategies we will discuss as we proceed in the study. Now let's look at the swing. Let's look at the chart. Now you see that with your eyes, visibly you can see that these are major swings. Now once you have identified these major swings, you can now wait for price to come back to this zone and see what can happen. For example, if you have identified this and the price is here, what you need to do is now be watchful as price navigates towards this point. When it gets to this point, you want to take advantage of what is going to happen around here. If it's going to continue going up or it will break all the way down. So this is how you trade. Trading is more of waiting than acting. You have to wait, then react. Thank you for attending this class. I'll see you in the next class. Thank you.